So we finished with fixed income securities by talking about both the money markets and capital markets. Now we move on to equity. Um, Equity markets are broken down in between primarily two types of securities: common stock, which is a residual claim. It is the final claim, I guess you would say, on the ownership of a company. The bondholders are always going to get paid first. The nice thing about common stock is the shareholders have limited liability, meaning that they cannot be held responsible for any impropriety related to the company. Preferred stock has priority to common stock, meaning that preferred stockholders have to get paid first. So the order of priority would be debt holders, preferred stock, and then whatever's left over would go to common stockholders. Preferred stocks typically pay a fixed dividend, and for the most part, they are outstanding in perpetuity or forever. But as a result of the fixed dividend, they do have limited gains. Preferred stock is also, for the most part, non-voting. The preferred stockholders have no say-so in how a company is run. Common stockholders theoretically do have, and if you own enough common stock, that you have a significant stake in a company, you will certainly have a say-so in how the company is operated. Both preferred and common stock receive preferential treatment for corporate taxes. They exclude 70% of dividends earned, so corporations can buy common stock, and those dividends receive preferential tax treatment. Other types of securities. ADRs, or American Depository Receipts, are I've never heard them called as American Depository Shares, but they are receipts related to the shares of foreign stocks. They allow foreign stocks to trade on U.S. exchanges. They represent ownership in a foreign security. Historically, foreign companies were not traded in the U.S. That's large foreign corporations are more and more are traded on U.S. exchanges, but this ADRs have been historically a vehicle that allowed foreign stocks to trade in the U.S. Capital gains and dividend yields. Hopefully this is a review from financial management. The example here, if you buy a share of stock and hold it for $50, hold it for a year, collect a $1 dividend, and then sell the stock at the end of the year for $54, what were your dividend yield, capital gain yield, and your total return? So your down here, our total return is the price we sold it for minus the price we bought it for, plus the dividend we received divided by the price we bought it for. So that's 54 minus 50 plus 1 divided by 50, or 10%. The dividend yield is just the dividend divided by the price you paid it for it, or 1 divided by 50, which is 2%. And the capital gain yield is simply the price you sold it for minus the price you bought it for, divided by the price you paid for the stock. So that's 54 minus 50 divided by 50, or 8%. The dividend yield and the capital gain yield must add up to the total return. So fairly simple calculations. Okay, Figure 2.8 is an example listing of stocks this is something, if you opened up a Wall Street Journal, you would see something like this. You have the name of the company, the symbol, the previous closing price, the net change, volume, 52-week high and low, the dividend yield, price earnings rate, price earnings ratio, and then year to date change in percent.